to our channel. For those of you who are familiar with professional tax advisors, we are rolling out a new program, ProTax Plus. This is where we're going to be able to give you more information in the form of education through these types of videos. Today, we're going to be starting with the big, beautiful bill. I know a lot of people have been asking, calling, and trying to find out what exactly is in the big, beautiful bill that's going to affect them. We're going to run through some of the major points, some of the areas where you might be concerned about changes that are going to occur to your taxes. And we're going to focus very much on the tax side of the big, beautiful bill. And any of these that you want a little more clarification on, we might have an individual video for more clarification. We're just going to do the summaries, recap the basics that are going to be happening, starting with Section 199A. I know a lot of you are not familiar with 199A, but for a quick recap, that's related to bonus depreciation and qualified business income deductions. So if you have a business, you've probably heard me talk about depreciation. Depreciation is a really important part of your taxation when you own a business. More specifically, bonus depreciation is what allows us to take additional depreciation for the first year of the expense of an item, something that we've purchased. A good example of this would be when we go and purchase a vehicle for use inside of our business. Typically, we'd be able to depreciate a certain amount of that over the course of 5 years, roughly 20%. And we are now allowed to take bonus depreciation. In the Tax Cuts and Jobs Act, we were allowed to take 100% bonus depreciation, meaning that we're able to take the entire cost of a vehicle through the process of both regular depreciation and 199 bonus depreciation. In the Tax Cuts and Jobs Act, there was a declining bonus depreciation over the course of 6 years, meaning that every year we were able to take less and less and less bonus. If there was no changes to the Tax Cuts and Jobs Act, we'd be to the point where we were able to take 40% bonus depreciation in 2026. Thanks to the big, beautiful bill, we have reinstituted 100% bonus depreciation on certain expenditures that are qualified. That has also been placed into the tax code as permanent. We won't see the declining bonus depreciation anymore. We're going to have direct bonus depreciation. You can still elect to not take your bonus depreciation, which is something you should talk with me individually about for your specific case. The other really neat part about 199A is the qualified business income deductions, which was also made permanent inside the big, beautiful bill. This means that those businesses that are allowed to have a deduction for having qualified expenses will be able to continue to get that deduction against their ordinary taxes. If you have a small business, I'm sure you're aware of this. If you don't have a small business, this really doesn't apply to you. There's a lot of pieces inside the big, beautiful bill that really are not going to be effective for most people. They're a little bit more obscure or therefore higher earning individuals. We'll mention a couple of these just so that you know that they're there, that they exist, but they're not really going to affect the majority of my client base. For example, we do have the qualified business stock, which is where we had an increase in how much you could take as a deduction as a business owner for investing in qualified business stock. It's a really complicated scenario. We're not going to break it down here today. We're going to focus on the things that actually are affecting you. Be aware that if you are interested in having some qualified small business stock, the bill does give an advantage for doing so. Some of the other things that we've seen is the research and development that has been allowed to be expensed instead of depreciated is also been renewed inside the big, beautiful bill. Any company that has a lot of research and development, they're going to be very happy because they're going to be able to expense more of that under the new tax law. The other really neat one that, again, is not going to be effective for most people is the opportunity zones in the Tax Cuts and Jobs Act. The opportunity zones were introduced in a way that created a lot of tax deductions for people who invested into specific areas. And the federal government came out and they highlighted what those areas were, and they gave us specific guidelines under how that'll work. They were set to sunset, but they did not. They were made permanent inside this new tax bill. Not only were they made permanent, but they actually increased how much benefit you would get out of investment into these opportunity zones. One of the sad things that happened inside the big, beautiful bill where there was a lot of frustration is we did have a scale back on the clean energy credits. For about 10 years now, we've been pretty used to having energy credits for our solar and credits for our hybrid cars. Most of that has gone away. We're going to see that a lot of that industry is going to start changing tactics in terms of how they do sales. We're going to see that those credits are going to be going away on the tax return. Anyone who has a carryover credit from a previous year, that is still going to be there for you. You're still going to be able to use that carryover credit until it's exhausted. There won't be new credits as of 2020. Now we get to one that actually is going to affect people. The Big Beautiful Bill did create an above line deduction. For those of you guys who are familiar, there's two kinds of deductions on your 1040. We've got a below line and we got an above line. This is just a term of art. We have a deduction that is not related to the standard or itemization, which is on the Schedule A. This deduction happens above that and is taken directly out of your gross income prior to the modified adjusted gross income. New this year, if you're single, you'll get $1,000 as an above line deduction for giving to a qualified charity. If you're married filing joint, you can give up to $2,000, which will qualify for that above line deduction. This doesn't have an effect for those people that are itemizers. They will not qualify for the above line deduction because that will be moved onto their Schedule A. It will be part of their itemization if they're giving to charity and they are itemizing. Unfortunately, there was a floor introduced for charitable donations on the Schedule A. The 0.5% of your adjusted gross would be considered the floor for your charitable donations. Now, we've got a lot of other areas that are going to affect most people when it comes to the Big Beautiful Bill. The Tax Cuts and Jobs Act and the Big Beautiful Bill, they're very related because a lot of the Tax Cuts and Jobs Act was made permanent under the Big Beautiful Bill. Some of the things that we're going to see that were made permanent is the current individual tax rates. They're going to remain steady, which is a really good thing. They were set to sunset in 2026. Prior to the tax cuts, we were looking at 10%, 15%, 25%, 35%, so on and so on. Where we're at now is 10%, 12%, 22%, 24%, 32%, 35%, and 37% is our top marginal rate. These rates are much more favorable than prior to the Tax Cuts and Jobs Act. Most of you are going to feel that your taxes don't go up. We're really concerned that if they didn't stop this from sunsetting, everyone's taxes were going to go up and everyone was going to be a little bit upset when they came to see me come April. That has been made permanent. The standard deduction, which was doubled in 2018, that has also been made permanent. Also, what's really interesting about that standard deduction is that standard deduction was made inflation adjusted. There was no inflation adjustments prior to the Tax Cuts and Jobs Act, which means that from 1992 to 2018, it was not inflation adjusted. Now in 2018, we started making that inflation adjusted. We started with $24,000 as the standard deduction. As of 2025, the standard deduction is now $30,000 because it has been inflation adjusted. That has been made permanent along with the inflation adjustment. That is also now a permanent part of the tax code and is not set to sunset anymore. Along with that standard deduction, there has been a bonus given for the next 4 years, 25, 26, 27, and 28, where you will get an additional $750 if you're single and $1,500 for married filing joint added onto your standard deduction. Your standard deduction is going to be even larger for a married filing couple. That'd be $32,500 instead of the $30,000 that was set before. For the next 4 years, you're going to get that bonus. We'll see what happens with the tax codes between now and 2028. My guess is they're wanting to make that bonus permanent. We'll see if they can do that. The personal exemptions, which were part of the tax code in 2017, they were never removed from the tax code, but they created a disallowment. They no longer allow personal exemptions. The disallow of that exemption is made permanent under the Big Beautiful Bill. Most likely, we're not going to see personal exemptions come back, with the exception of individuals who are older than 65. If you are older than 65 and your income is under the threshold, you are going to get a personal exemption again. That personal exemption is going to be $6,000 per individual. They're going to get that $6,000 allowance for the next 4 years until 2028. There is an income cap. Individuals who are over 65 years old and making more than $75,000 as a single or $150,000 as a married filing joint, they will phase out of the ability to take that $6,000 allowance. Now we get into some miscellaneous itemization. I know a lot of you guys were very frustrated when 2018 rolled around. We weren't allowed to take any deductions for work-related expenses. Sadly, that's going to still be the case. That's been made permanent inside the big, beautiful bill. Those miscellaneous deductions are still not allowed. And that's been made permanent. There is no sunsetting expectation there. But on the SALT deductions, the state and local tax, we've had a cap on that of $10,000, and there's been a lot of frustration. In fact, a lot of states have created pass-through entity laws that have allowed business to pass their state taxes through their business entity to avoid that $10,000 cap. If you're not aware of that and you have a business, please give me a call. We want to get you to elect that pass-through entity for Arizona. That is a law that Arizona does allow for. The SALT deduction used to be capped at $10,000, and the Big Beautiful Bill has changed that exemption to $40,000. That is another item that will sunset in 2029. We're going to see that SALT tax increased, but only through till 2029, when it will revert back to the $10,000 maximum. Here's the one that I think everyone's really wanting to know about, and that's no tax on tips, no tax on overtimes. I know I've got a lot of clients that are in overtime every single year. They're going to be really curious how this affects them. Let's get into that one. Let's talk about the no tax on tips and the no tax on overtime. When they say it, it's a little deceptive because they're saying there's no tax on tips, no tax on overtime, but that's not exactly how it's designed to work. It's designed to work to give you an above line deduction. Again, we're going to go back to that deduction that happens above line, which is happening before your adjusted modified gross. If you have tips, and the IRS is going to be very specific about what industries are allowed or qualified for having tips. They are still working on that list. We have not been given that list yet. We expect it to come out before December. If you have tips and you are in a service industry that is allowed, you are going to get up to a $12,500 deduction for single or a $25,000 deduction for married filing joint against your tip wage, which has to be reported on your W-2 and has to be a card transaction. It cannot be a cash transaction. We're going to see payroll service providers are going to be scrambling to figure out how to report this appropriately on your W-2 and to separate out the difference between cash and card. That should be something that's reported on your W-2. It's nothing you have to do. You simply bring it to me. We'll take a look at whether or not you qualify, and we'll take the tips, and that will be equal to a deduction of up to $25,000 for married filing joint, $12,500 for a single individual, which will reduce overall taxable income by reducing your gross income. Let's get into overtime. Same basic setup, same structure where you qualify for an above line deduction of $12,500 for single, $25,000 for married filing joint. Now here's where it gets really interesting, and this is where payroll companies are going to get really frustrated because the portion that's allowed for the deduction is the amount of overtime that is qualified, and it's only the half. When we work overtime, you get 1.5 times your rate. The one part of your overtime, not deductible. Just the extra half is deductible. If you make $10 an hour, and in overtime you're making $15 an hour, the $10 that hour is not deductible. Only the $5 is deductible that hour, which again is the responsibility of the payroll company and your HR department to manage what portion is taxable. It should be reported on your W-2s. This is not something you have to do, but it's something you should be aware of so that you can double check they did their work correctly. If you've been working with me at all, you know I have very little trust in payroll companies and HR departments. They tend to make my job much harder. We want to definitely double check their work and make sure you're getting the best deduction based on your overtime. A new deduction that we've not had before, you've probably heard it in the news. This is a deduction for interest on your car loan. When we are in itemization, the 4 things we can itemize currently has been the interest on your home, your taxes paid to the state, your medical after the floor, and your charitable contribution. Well, now there's a new 5th category, and that's going to be the interest on your car. Just like we have interest on your home, you're going to be qualified to take interest on your car. That means for 2025, we are going to want to be able to look at our bank statements where our car loans are and look at the interest paid, because that might be the difference between pushing us into itemization or remaining at the standard deduction. That's going to allow for a slightly larger itemization for some of our clients. Historically, since 2018, we've been seeing about 6% nationwide in itemization. My office has seen probably about 4% of itemization. I think that with the interest on your car loan and the SALT tax being increased, we're going to see that go up just a little bit. We're going to see a few more people itemizing in 2025. We're going to look a little more closely at that coming into this next tax season. For businesses, there are some new deductions, new credits that have been put out there, some expansions of current ones. We're really not going to jump into those. Those are for our business clients. It's not going to apply to the majority of the people in my office. There's been an expansion of the employer-provided child care credits. Your employer might offer better child care for you in the future because of this. Family and medical leave credits have been boosted and expanded. The adoption credit has been made permanent. It was in there, designed to sunset. It's been made permanent, up to $5,000 adoption credit. We have the scholarship granting tax credit. This is related to anyone who is giving money to a scholarship style program that is qualified, is going to give you a credit up to $1,700. Next, we're going to talk about the expansion of the qualified tuition program. Anyone out there who has a 529 and has been using that 529 for the last couple of years to help pay for qualified school expenses that is not college, such as private school all the way K through 12, or any other type of school that was not previously qualified, that program has been expanded under the Big Beautiful Bill and made permanent. The 529 will permanently qualify to pay for a private schooling K through 12. We're also going to see a lot of the expansion of trade schools that were brought in under the Tax Cuts and Jobs Act have also been made permanent. The increase to the alternative minimum tax. Anyone that's been hit with alternative minimum tax in the past, essentially, if you have a deduction greater than 25% of your overall income, your gross adjusted income, if you have a deduction greater than 25%, then we impose minimum tax on you. That has been expanded from 25% to 50%, which means that we can take a much larger deduction without running into that alternative minimum tax. So we're going to see a benefit for some of our higher earners with those high deductions. The student loan discharge on death or disability has been made tax-free, meaning that if you have student loans at the time of your death, those student loans used to pass on to your estate as discharged and taxable to your estate. That is no longer the case. Upon death, the discharge is considered tax-free. This is also qualified on permanent disability. If you get qualified through the Social Security Administration for disability, then they will discharge any remainder of your student loan debt. They will discharge it, give you a 1099-C, but it's considered non-taxable. You won't have to pay the taxes on that discharge. We've had a lot of natural disasters recently. We've kind of seen an uptick in those. The response was under this bill. We are going to see that the personal casualty loss relief has been further extended. It's kind of always been there, but it is something that they look at and renew every year. Inside this bill, they again renewed that disaster relief. Essentially, anyone who has a personal loss inside a qualified disaster zone, that personal loss is considered a tax deduction. It does have to be a federal disaster zone. There has been wording placed into the bill that makes the state disaster zones can be qualified. They aren't necessarily guaranteed to be qualified, but they can be qualified. So they've created a path for state natural disasters to also turn into tax deductions. Work-related moving expenses. In 2018, we had no work-related moving expenses unless you were an active duty military. 2017, we had those moving expenses available to us. In the Big Beautiful Bill, they've kept it the same. We're not going to see any new moving expenses come back as deductions unless you are active duty military. Now, when it comes to the child tax credit, we've had this child tax credit that went from $1,000 to $2,000, and then they kept that in there. That was made permanent, but they did a really neat thing with it. They made it inflation adjusted. Every single year, we're going to see the child tax credit go up just a little bit based on inflation. We were also given a bonus on the child tax credit. Again, it sunsets in 2028, but we're going to see an extra $200 to the child tax credit. So instead of $2,000, we're going to see $2,200. And that bonus is set to sunset in 2028. We are going to see inflation adjustment on the primary child tax credit each year moving forward. And the last piece of the big beautiful bill that we're going to talk about tonight is the Trump accounts. This is an area where a lot of people are a little confused. They don't really know what the Trump account is. It is a voluntary program that you can choose to be a part of. It's designed primarily for children under the age of 17. For any child that is born between 2025 and 2028, $1,000 will automatically be put inside a Trump account in the name of your child by the federal government. It'll act like a credit. That additional credit will go into that account in the name of your child. That $1,000 will get that account open and get it started. It's meant to be a government-funded, financially backed product. We're not really sure exactly how this is going to work yet. We're holding off on some clarification from the IRS, some clarification on who's going to manage it and what that structure might look like. But we do know that they're working hard to get that in place because it is something that's in the bill. You'll be able to see that on your tax return. There'll be a place where we'll actually put that credit on. You won't physically see the credit because it'll go into the Trump account. And then for anyone else that wants to elect to put money into the Trump account, we're waiting on some clarification of what that might mean. We're waiting to see what that might look like. What we expect is probably going to happen is if you're due a refund or if you're due a credit, we'll be able to apply some of those credits to a Trump account. You will see that occur and it'll be placed in the name and social security number of your child that's under the age of 17. We're just waiting on a little bit more clarification from the IRS on how they're going to handle that. But that is going to be a thing that we're going to talk about this next tax season. That was a lot of information in a very short time. I hope you guys are able to break that down. You can always pause, rewind, go back, take a second look here. But this is what we can expect for the 2025 tax season. These are the things that are going to be affecting you. Hopefully we'll have a little bit more information for you coming up in a future post. For right now, we're going to call this good night and we're going to sign off.